Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation, bringing you another subscriber request series, 2-minute drill, lessons in valuation. Today, I'm going to cover the company KLAC. Now, this is a semiconductor company. It's got some interesting results here recently. They had a really good earnings report. Wall Street, for some reason, didn't like it. The company raised their dividend and actually increased their buyback program. But Wall Street was not impressed. So anyway, let's go ahead and move to the fast graphs and see what we see here for KLAC. First of all, as I like to do, I'm going to take the price off of the graph. I'm going to look at earnings per share. Now, this is a very strong growth company. It's A- rated, has a little more debt than I like, but it's a 59.89% debt to capital. It's trading at a very high current PE of 21.8, which gives it only an earnings yield of 4.59%, a dividend yield of 1%. But the company is what I would call quasi-cyclical. There were periods where earnings were flat. They did pay a special dividend, looks like about $17 or $18 in fiscal year 2015. The company has a July fiscal year, but earnings growth has been pretty strong. So I'm going to shorten the time frame here and see going from 2012, the growth has averaged about 13%, shorten it a little more, and it's now up to 19%. So the more recent earnings growth, with the exception of 2023, has been very strong. When I add weekly closing stock prices, you once again see how closely the market price has tracked the earnings growth rate. P equals growth rate of 19.01%. The orange line is a PE of 19. The blue line in this time frame is a PE of 17.66. So you can see the company has traded at valuations lower than that at times and higher than that at times. And it recently got pretty overvalued. It corrected to where it actually got pretty close to fair value or in fair value earlier this year in the beginning of April. It's now rallied again a little bit. So I would consider it a little overvalued, especially considering we don't expect much in the way of growth coming up next year. The analysts don't. So let's go ahead and look at what the analysts are forecasting. There are 23 analysts. They are forecasting $32.47 for this fiscal year, which ends in June, so just a few months. And then they're only forecasting less than 2% for 2026, but then followed by 14%. So these coming years are a little bit problematic. The company does have a pretty good analyst scorecard where the analysts have been pretty accurate with a 10% margin on a 1-year forward and 2-year forward. But the stock is a little pricey for my taste, but I do like this company very much. I think if you can buy it at an attractive price like you could have back here in 2022, 2023, it would have been an excellent time to be buying this stock. So I'd be patient and wait for it at this point, but it looks very good. Now, going through some other quick things real quickly, they did decide that they were going to up their buyback program. I don't really like that in light of the fact that the stock is fully valued here. Let's take a quick glance at margins. Margins have stayed pretty steady, if not slightly increasing recently. So that's a real good sign. So all in all, I really like this company as a potential long-term growth and even dividend growth stock with a moderately low yield if you could buy it at the right price. I don't think we're there yet, but I think we're getting close. Anyway, this has been Chuck Carnevale bringing you a 2-minute drill on KLAC. This was a subscriber request. I didn't recommend this stock. This is a stock that subscribers asked me to see, so keep in mind when you're making your comments later. If you like the video, ring the bell, give me a like, subscribe to our YouTube channel, and take a look at subscribing to FastGraphs. You can just see how powerful this tool is in helping you make sound, prudent, and profitable long-term investment decisions. Thanks for watching.